Hey, Kevin, hope all is well, sir. Good to see you. So it is 11 o'clock, and I am excited about today's conversation because I'm actually going to be joined by a good friend and an expert individual that is a specialist in the space that we're actually going to be discussing. Um, this individual is Joseph Ovard, and he is the managing director of J. Paul Capital, and we'll get a little bit into his story as well as what he does. But as I mentioned, today's conversation is one that I'm excited about because it's a topic that I've discussed previously in the past, and I thought it would be very helpful and beneficial to actually bring another individual in that's actually working in the specific space and doing the things that I see a lot of the clients that I work with do. And ultimately, I think it's a great opportunity to learn as well as present some questions and get some questions addressed. So for those that don't know, my name is Jamel Nelson. I'm the owner and founder of Nelson and Associates, and we specialize in accounting for real estate professionals, real estate developers, real estate investors. And with that said, the topic that we're discussing today is along the lines of real estate investments and syndications. And real estate syndications are very, very popular for many because it's an opportunity for those that don't necessarily have the full capital to invest on their own. They can actually pull those resources together and work with other partners and other investors to make a dream become a reality if it is their desire to become an investor. So with that, there's definitely opportunities available to get in the game, but it's very important to really understand implications, the tax impacts of what it looks like when you're actually involving yourself with a real estate syndication, as well as what is the relationship with regards to your responsibility and your role. So to help kind of address some of those questions and get some of those questions answered, I thought it would be very, very fitting to have Joseph on the call today and share his experience. So let me tell you a little bit about Joseph, and then he'll kind of expand. Joseph is the managing partner of J. Paul Capital, and they're a real estate investment firm that specializes in multifamily investments. And as I mentioned, this is definitely in line with what the topic is going to be today, because he is very involved with the process of a syndication and what that looks like from a manager perspective and then working with investors. So with that said, what I want to do is allow Joseph to step in now, introduce himself, and then I'd also like to address a few questions with him. And then if you guys have any questions on your side, feel free to type those in the comment box, and I'll be sure to monitor that so that if we get anything coming in, we'll be able to address those with Joseph real time. So without further ado, Joseph, please introduce yourself and tell us a little bit about you.
All right, thank you very much for having me on here. It's a pleasure. I've always cared a lot about educating others and really kind of helping others, invest in this space. But a little bit of background on me, probably a little over 10 years ago, I really kind of became interested in commercial real estate rather than residential. I see residential kind of go all over the place, and so commercial real estate just seemed a little bit more stable. I knew some people that had gotten into it, and what really kind of opened my eyes to it was I was working for a company. I was most of my professional background has been in operations management, production management, manufacturing companies, and things like that, and so the operations side is really kind of what you know kind of got me prepared for this space. But so I spoke with we were renting basically a warehouse from this gentleman who he owned a construction company and they built office buildings. So basically, he built himself, bought a piece of land and built himself this big complex. And his retirement plan was basically renting out spaces that he had built. And I was like, oh, I would love to get into something like that, some kind of leading up to 2020 and a lot of retail and the commercial side of real estate really kind of took a dive that a lot of people didn't expect. And so it was coming off the tail end of all of that, I got introduced to these large multifamily complexes and the process of syndications and really kind of made it feasible to kind of jump in. And so that's when I started my company, J. Paul Capital. It really kind of opened my eyes to how not only how I could get involved on the management side and the operations side of these properties, because when you're buying a large multifamily property, it's more like you're buying a business. It functions like a business, and that's the kind of world that I understood. And so that was kind of what led me to start my company was education like this,
Yeah.
information was shared, where syndications were a possibility, where you could pool investor money to be able to take down these large properties. And that's kind of the background of me getting started in these multifamily syndications, was just kind of me discovering little bits of information along the way that kind of taught me how this all worked, basically. So I'm very passionate about sharing information like this. So I'm very, very grateful for the opportunity to share today. So
That's awesome. That's awesome. So with that in mind, when we say real estate syndication, I think that for the average person, it probably goes over their head. They don't really understand the concept and really what it means. But in a nutshell, it's essentially you're taking a bunch of people's money, pulling it together to make it a bigger pot of money so that you can actually go out and purchase a bigger type of property or a bigger cash flowing type of investment. And with that in mind, you're in a position where you can have a select few investors do this, or it can be several hundred investors that are doing this. So the scenario can be endless in terms of what the opportunity is. But from your perspective, how has your involvement with syndications and your desire to actually pursue that, how has that changed your perspective and your mindset from just the traditional way of becoming a real estate investor? And for most individuals, when they think of real estate investing, it may potentially be doing a real estate investment deal as a residential property versus multifamily. So what kind of things have kind of stood out to you where you now have a different perspective per se?
and that was a huge one. Like since I've started this company, I've met a lot of people that have flipped houses and done all this different types of smaller scale real estate investing, which a
Yeah,
lot of people can be really successful with.
yeah,
A lot of people I know that I partner with now started out flipping single family homes or doing short-term rentals, or things like that. A good
yeah,
friend of mine I actually went to high school with has owns a number of single family and duplexes and things like that he rents out and loves that kind of space.
yeah,
I took the opposite route and jumped right into these big commercial size deals where and a little bit more information on how these syndication deals work is what it does is you're basically starting a security
yeah,
where you are whenever you're pooling investor money, whether it's a whole bunch of investors or even just a small handful, um uh, you know it, it you're basically investing into a security. There's all sorts of legal contracts and stuff that all go into all of this, of course. Whenever you're dealing with investor money, you hire a securities attorney and make sure everything is set up and all of that. But it's like I said before, it's a lot more like you're investing in a large business. My very first syndication deal
yeah,
was a 300 unit apartment complex in Houston, Texas. And I could have taken, what my personal investment was and brought in a couple of investors and, got something smaller. But whenever you're investing in a larger property like that, the returns are so much more stable if you know what you're doing. If you're buying the right property at the right price and you know how to operate that property, where you can, just like a business, everything is focused on your income, your net operating income.
Yep.
So when you're dealing with a larger property like that, it's a non-recourse business loan. It's not like a mortgage where it's tied to your personal credit score and all that kind of stuff.
Yep.
But it's all about investing with the right operators, the right managing partners, because
Yep.
in these syndication deals, you've got the managing partners and the limited partners. Limited partners, the people who are investing their funds. You put your money in and you see the returns, you see the cash flow. There's so many. I'll talk about all the
Yep.
benefits of being that passive investor. But as a
Yep.
as a passive investor, you put your money in, and the operators run it while you enjoy the cash flow and the returns that come from the property. On the
Absolutely.
management side of things, you're kind of running the day-to-day operations with an apartment complex that large. You're
Yep.
working with third-party management companies, and so you're kind of managing the managers that do the day-to-day.
Yep.
And so in my mind, I could have gone out and bought a small piece of property or a small piece of real estate that I could rent out and get a little bit of monthly passive income. Or I could get a small slice of a very large, $50 million apartment complex, by pooling some investor money and helping to fund this acquisition of this large property. So it's a very small slice of a very big pie instead of enjoying my little teeny tiny pie over here, kind of thing. Basically, was the draw of that
Yep.
syndication
Yep.
model that really kind of got me
Absolutely.
started.
Absolutely. I like the idea of a smaller piece of the pie, but a bigger return and at the end of the day.
And more
So
stable
you
returns.
exactly stable. So that is very key, stable. You obviously, if you're in a position where you have multiple doors, multiple units in the hundreds, if not more, you're in a situation where you can definitely predict and have predictability in terms of your income. Versus if you are limited with the single family route or multi or duplex type of situation. Now you're in a situation where it could be very sporadic. That leads me to my next question. In terms of the benefits, what do you see being the biggest benefits of participating in a syndication and in pursuing that type of route if you are or if someone is interested in actually taking a look at it?
Yeah, absolutely. I mean, the one of the biggest benefits is tax benefits. Where and I mean, Jamel can talk all about that. Like, well, I always say I'm not a tax advisor. Talk to your CPA. So talk to Jamel about it. But as far as like tax benefits, but when you're investing in a large fund like that, and a large building, the depreciation, the cost segregation, um, which I always have trouble explaining what all these terms mean in a lot of detail, but both help significantly
Yeah.
with your tax bill as a passive investor.
Yeah.
And on top of that, when you're investing in a property like this that cash flows, then you enjoy not just the eventual returns after the property is eventually sold or traded again, but you enjoy the cash flow.
Yeah.
Most syndications, the property will hopefully cash flow monthly. Usually the
Yeah.
distributions are quarterly, just because month to month there'll be some flow, but usually each quarter you'll have a tax return. Usually for my investors, what I usually offer, in my deals, like, because I'm all about buying the right property at the right time, at the right price, making sure that because there's a lot of deals out there, and it's all about finding the right one and partnering with the right operators. I want to talk a little bit about that as
Yeah.
well, later
Yeah.
on, is making sure you're finding the right partners. But
Yeah.
usually what I offer is, um, you know what I shoot for when I'm shopping deals and talking to brokers is doubling my investors' money in 3 to 5 years is my goal. So you put in 100,000 in 3 to 5 years. I want you walking away with at least 200,000 in that 3 to 5 year hold. At that point, whether we restructure, refinance, or trade and put our money into something new is
Yep.
usually what I go for. So
Yeah.
really high, really stable returns. Because when you're buying a property like this, you're dealing with an incredible multiplier. If you have a
Yep.
single family, or let's say you have a duplex and you're renting it out, and one of your tenants moves out, you're automatically 50% vacant.
Yep.
But if you have,
Exactly.
100 doors, just for easy math, and 10 of your tenants move, you're still 90% occupied.
Yep. Yep.
You a lot of times, and in returns, in terms of cash flow, I'm sorry, I could talk about this all day long. I'll try to keep this as concise as possible,
No, keep it going. Keep it going.
um, but depending on, and the thing that's interesting that I actually really like about this, just because I mean this is what I do, but is every deal is different. Every apartment complex, just like any business, is gonna have its differences. Not just in size, but in performance, especially in terms of location and the competition and other apartment complexes that are nearby, and things like that. So there's a lot of different things to consider when you're purchasing an apartment complex. Sometimes you're buying an apartment complex that needs some work. If
Yep.
it's like a C property and you have some capital expenditure funds, you're going to go in and fix things up so that you can bring things back up to where market rent should be,
Yep.
and which will drastically increase the potential of the property in 3 to 5 years. Once everything's fixed up and
Yep.
stabilized and you sell it, that's when you really make your money. And
Yep.
so I've been involved in a couple of deals where cash flow is smaller in the first year, because that's when we're doing all the work and fixing things up, and then it increases to make up for it in later years, kind of thing. So cash flow might be different from deal to deal. Usually as an investor, the cash flow isn't nearly as important as the overall returns. You're putting your hard-earned money in there. You could get a little bit back every quarter,
Yep.
which is nice, but mostly what you want is the operators that are gonna bring in those long-term
Yep.
returns.
Absolutely. Absolutely. So in my experience, most individuals that get involved with the syndication, their expectation is that they're going to give you their hard-earned money, as you said, with the expectation that they get it back, and not only just get it back with the principal, but they want money on top of it. So when you're actually going out to identify potential investors, I'm assuming, and I'm sure you're doing what we call due diligence, where you're actually going through that process to really identify the property, identify the market, to really assess the condition, to determine whether or not you do need to flush it out with additional capital expenditures, or if it's ready to go. And ultimately, you have to take all those things into account, because at the end of the day, when you bring in investors, the expectation is that you're going to provide them with a specific type of return. And I want to talk about a little bit about that. The expectation is that you're going to give them a return, but how can we guarantee it? And how can we even guess what it will be without really knowing what the numbers are and doing the due diligence? So that's a huge, huge aspect that is to be considered, and that is part of the process at the beginning.
Absolutely. Yeah. There's a lot of due diligence involved when you're buying larger properties. Like right now, um my company and along with a few other partners are purchasing uh, uh, a property down in Texas, and another one. It's outside of Houston, this one, but we started due diligence about a week ago, and it's going to go on for about 3 more weeks. Just going through, like I said before, we partner with third party property management companies. We found a really good partner. They're going really in depth and inspecting units and electrical and roofs, and so there's a lot of there's a lot of moving parts with something like this, which is why, like, usually a due diligence period, I don't settle for less than 30 days to
Yep.
really do due diligence on their financials and make sure what they're stating in not just their marketing package but their actual financials
Yep.
are verified, and
Yep.
because and another big part that they do is they shop competition around the apartment complex. Because I do, I've got a whole team that does a lot of research into every, not just market but sub market and neighborhood and everything, just to really make sure that we put a lot of work up front to make sure
Yep.
that it's as secure as it can be.
Yep.
With
Yep.
any investment, there's risk. My
Yep.
SEC attorney would shoot me if I went on this publicly and didn't say every investment has
That is
risk.
true. That is true. Yeah.
But I've in all my time doing this and talking with so many different people that own thousands of units and manage all these different properties, the worst case scenario I've heard is that their investors still made their money back plus so much percent more. Like like usually you're shooting for like 20% per year, 3 to 5 year hold, you're going to double your money.
Yep.
The worst I've ever heard was 8 or 9%
Hmm.
per year.
Hmm.
So in some cases you at least match inflation.
Yeah.
But that's the worst case scenario I've heard. I've heard upwards of 35%,
Yep. Yep.
in 18 months.
Hey, 8% sounds a lot better than what you can get at the bank for now. That's for sure.
Absolutely.
Hey, Kevin, I've seen some of your questions come through, and they're actually going to hit on a couple questions that I have to address. So hold tight for me, and if we don't clear it up, I'll clarify with you before we move on. So with regards to the structure, we threw out the term GP, LP, we threw out the term sponsor, investor. Can you kind of explain what the typical structure of a syndication is and what it looks like?
Mm-hmm. Well, I'll give you two different examples of deals that we've taken down. One that we are taking down currently. Oftentimes, it's a simple split of like 70-30. So the investors, the people putting their money into the deal, own usually at least 70% of the deal.
Yep.
And the managing partners hold equity in the other 30%. And with that 70%, you guys, the passive investors still make their returns, and you guys get paid first.
Yep.
Almost always, we offer a preferred return to our limited partners of anywhere from 6 to 8%. Like right now, I have a deal that's 70-30, and we offer a 7% preferred return annually. And so you guys, like if the property makes 7%, under 7% returns in cash flow, you guys get paid and we don't for that quarter. As the managing partners, we don't enjoy the cash flow until our investors do. Anything over and above that, we'll get the other 30%. And again, anything left over goes back to you guys. It's all a matter of how it works. There's another deal where we've had to extend a couple of times. We've had to restructure the financing, and instead of giving our investors less, we restructured it to a 90-10. So we only own 10% of another property that we're closed on. And we're the management is still getting compensated. The investors are still going to get their amazing returns. And we did that to make it so our investors we're getting their returns and we're satisfied before we got anything out of it, basically.
Awesome. So in the situation where you have a syndication, you have different roles. Your GP or your managing individual that's actually overseeing and managing the day-to-day is going to be treated differently when it comes to tax implications. They're going to be treated differently than the regular investor, which is considered the minority investor. And this is where it becomes very, very important to really understand the difference between having real estate professional status, having non-passive income, and having passive income. And depending on where you sit as it relates to your involvement with the syndication, you're going to fall in one of those categories. And each of those categories are going to still benefit you in terms of providing tax deductions. But you're going to benefit more greatly if you are to be considered the real estate professional or the non-passive investor. And this is where really understanding how that works, how does that fit in with your specific overall financial situation, because you may not necessarily be involved with just this one opportunity. You may have other syndications that you're involved with. You may have another W-2 income job, another business. So we factor in all of these things and scenarios to really identify if you take losses in this particular area or category or property, how is that going to affect your overall situation? So it's really important to understand the differences, and ultimately, without getting into too much detail, the individual that is considered the real estate professional, they're going to benefit much more greatly than the passive investor, but the passive investor does still have opportunities to benefit because they can identify other passive opportunities that they're involved with to offset. So that was something that I wanted to throw out there, because that's a question that comes up oftentimes with clients that are not too familiar with the treatment. And depending on what that classification is, that's going to really drive and dictate the results of what your tax liability looks like. And on that note, when it comes to real estate, the biggest benefit of owning real estate as an investment property is that you're going to get cash flow, and you're going to be able to take advantage of your depreciation expense. And when you're taking advantage of depreciation expense, this is what we call phantom losses. You're not going to ultimately see your bank account get depleted because of depreciation expense. It's not tangible like that, but it's on paper. And the paper losses is what we are really going after when we have properties and investment properties, because we can utilize those losses to offset other areas of our situation. And if you're talking a commercial property or a syndication deal that's hosting a property that is in the couple hundred plus unit range, your depreciation expense is going to look a lot different than if it's a duplex or a single family residence or investment property. So those are huge benefits and things that we look at when it comes to why we should consider these type of investments and how are they going to benefit us at the end of the day, in terms of not just providing the cash flow and return, but how is it going to help us out on our tax bill. So one question that I'm gonna go to Kevin's question real quick. We talked a little bit about this in terms of, like, we got the structure down and we have the aspect of doing our due diligence. When it comes to an investor seeking out an opportunity to get involved with the real estate syndication, how are they to assess whether or not one particular sponsor or company is a good one to go with versus the other? Like, is there anything that they have available for them to make that assessment? Or is it just a matter of being in the know and having a personal relationship?
That's a really good question, and it's hard to just come up with one definitive answer, because there's a lot of guys out there, and there's a lot of and I always say, well, here's what I'll say about looking for the right people and the right sponsors for the deal. You always want to go with experienced operators, people, not just that, they own a lot of properties, but that they've taken a lot of them full cycle. They've owned them, they've sold them and got their investors' returns already, and all of that. First getting started, the only reason I got the first deals that I got was because I leaned on the credibility of the person who partnered with me to sponsor the deal. And that's just kind of how it works. But the reason I say always look, I would look for what I invest in personally. I always look at the operator and then the property. The property is important, and you want to do your own due diligence, but the most important due diligence is in the operators, because an experienced operator can take a so-so deal where the returns look okay. It might be kind of risky because of these factors. Experienced operators can turn that around and turn it into a great deal. An inexperienced operator could take a great deal and sink it.
Yep. Yep.
And
Yes.
so, and there are some guys that are relatively new and not as experienced. But as long as they're partnering with, right, because that was me at the beginning, was I was inexperienced, but I had partnered with people and built relationships with people that had experience and were willing to kind of mentor me as I was getting started. And so there is a certain factor of you kind of have to know them, and this is has to do with securities. When you're let me before I don't want to lose my train of thought here. My mind goes in so many different directions. I lose track and then
Hey, this is
remember.
exciting stuff. That's what happens. That's what happens.
Yeah, but so when when you're starting out, it like, oh yeah, that's what I was talking about.
Yeah.
Securities. Sorry. So there's sorry, I know I'm holding things up. I'm just trying to get thoughts straight in my
No,
head.
take your time. Take your time, my
Um,
friend.
but when you're new and you're trying to get started in syndications, there's a certain amount of who you know, because in securities there's different types of securities, and some syndications you have to have an existing relationships in order to invest in that deal, especially if you're not already in accredited investors. This is what I was getting to. I apologize for
Yep. No worries.
the pause there, but if and just very very basic, like if it's a 506c offering as a security, I'm not the best educational resource for this, so definitely do your own research. But a very basic education, a 506c is for accredited investors only, and so if you're not an accredited investor, you can't legally invest in it. And but you don't have to have a pre-existing relationship with the group that's funding that deal and putting that syndication together. There's a
Okay.
506b, which is actually what I prefer, because I can involve friends and family and people that I know and have a pre-existing relationship with, even if
Yep.
they're not accredited investors.
Yep. Yep.
And so there is a certain amount of who you know in whenever you're dealing with these kind of securities and investments and stuff, because it's a lot more. It's you're investing in a really what you're doing is you're investing in the business that owns the property.
Yep. Yep.
um
Yep.
is what a security is. And
Yep.
so you're guaranteed in the purchase agreement and the investor agreement, you're guaranteed certain returns and stuff like that through the group. And every group offers different things and different returns depending on the deal. And there's the option to invest in a fund that's investing in multiple different properties, so you can kind of diversify in that way. So it's an interesting industry, because and one of the things I really like about it and have really kind of dove into it since I started my company was, there's no one right way to do it. There's no one
Yep.
right answer. There's so
Yep.
many different options, and so you never have to be worried that, oh, is this the only one? Is this the
Yep.
only opportunity that I'll have? Like in some industries, you get the contract or you go out of business, that kind of
Yep.
thing. But
Yep.
with something like this, it's there's so many different ways to invest and everything. But kind of getting back to the original question, the most important due diligence you can do is on the operators, the people that are kind of running the show as far as the investment goes.
Awesome. 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 You mentioned this word a few times in that response. Accredited investor. What is an accredited investor?
So an accredited investor, if I'm remembering this right, there's been some talk about the government might be changing, or the SEC might be changing what an accredited investor is in the near future. As it stands right now, you either have to be an accredited investor, you have to have a net worth of at least $1 million. And it's different if you're married and you're kind of pooling with your spouse. I don't remember. I remember
Yep.
the individual
Yep.
requirements, but
Yep.
and
That's
then
yep.
or if you don't have a net worth of $1 million outside of your own residence, like your own equity in your home doesn't count. You have to make at least $250,000 for the last 2 or 3 years with
Yep.
reasonable expectation to make that much again the next year.
Yes.
So that's an accredited investor, and you might have to talk to your CPA or to your banker to get because to invest in the 506c offering, you have to be able to represent proof that yes, I am an accredited investor. You have to kind of pass the test, as it were.
Yep. Yep. Absolutely. Absolutely. That was actually a pretty consistent to what I understand. And when you're married, you obviously have pretty much can double whatever the minimum requirement is for an individual. So when it comes to I'm gonna go back a little bit to because this is a topic like a good one when it comes to really doing the due diligence on the property and what you're looking at. Um, is is this where having a good team in play and having different individuals that you're working with are going to really come into play to kind of assist you with making a decision on whether or not you have a good investment, or is it something that you can pretty much just do on your own? Or do you actually need to put boots on the ground and have that level of detail to really understand what's going on? Because when you're doing your due diligence, not only are you looking at a specific profile of the investment, whether it's a 100-unit apartment complex or office space, but you're looking at, and you alluded to this a little earlier, you're looking at the neighborhoods, you're looking at the market of the area, the affluency of the area. You're looking at what you can command in terms of rent rates and things like that. So when it comes to that, obviously some investors go all out with their due diligence, others don't. And those that don't typically are not going to have the desired outcome that they thought they would. But with more due diligent effort, then you're in a position where you ultimately can hedge your losses. So my question is, what specifically are you looking for in terms of the properties, the locations, the economies, and then more importantly, like who are the specific team people that you should be identifying working with? And I think you mentioned this a little earlier, and you said something about property management companies and things like that. So I just want to kind of revisit that a little bit because I know that's something that some people probably missed a little earlier.
Yeah, absolutely. Yeah, you can get a lot more in depth on that, especially. And this is something that especially starting out, I wouldn't do without a really experienced operating team, especially when you're investing in something large. A couple of quick examples. This first one wasn't one of my properties that I acquired, but as I was getting started in the industry, somebody I knew had bought a property, or were in due diligence on a property. And while they were doing it, they just, financials looked great. They did the financial due diligence and verified
Yep.
income and all that, kind of financial stuff, which is a lot of what I do as far as my role goes, is a lot of the financial reporting and things like that. Uh, so when they were doing their physical due diligence, they had discovered a pipe that was leaking, and it turns out it was like the main line pipe to the city, and like, so basically it would have cost them $300,000 to fix this had they not discovered it during due diligence. Since they did, and they were an experienced team, they could renegotiate with the seller and things were covered, and so that was taken care of instead of having it come up as an
Yep.
emergency or as a huge expense later that would cut into profits and cut into investor returns. And that's one of the reasons why due diligence is so important. The
Yep.
property that we're doing due diligence on right now, we just discovered about half of the breaker boxes in the units are not a very reputable brand, and it's
Mm,
something that will affect insurance costs going
yep.
forward if it's not addressed.
Yep.
Which is something that, even with my experience, I hadn't experienced that yet. Investing in this particular area, this particular brand of breaker box, I'm grateful for my partner that's based down in Houston,
Yep.
and has a lot of experience in both residential and commercial real estate in the area. He's like, we got to take a closer look at this. And so we got a report from our property management company that did all the physical inspections for us. Um, and they're a great company down there. And so they're coming back with a report of this is what it's going to cost, so we can, factor that into, costs that are going to be covered by the seller before closing, and all these different things. So like due diligence is extremely, especially when you're investing in something this large. A
Yeah,
breaker box and a duplex isn't a big deal. It's a cost and it'll affect things, but when you're talking 168 units and 80 of those are needing to be replaced, that's about $2,000 a box
yeah,
in a lot of cases. And so finding those things during due diligence is immensely important in the long-term success of the property, and making it so that it cash flows a lot quicker as well.
absolutely,
So
absolutely,
that
absolutely.
answered the question well enough as
Yes,
far as
sir.
like
Yep,
first part.
that answered the question. Just one more thing I want you to touch on in terms of the due diligence. You're obviously working with a team of individuals. So, who are some key people um, that are really contributing to the success of not necessarily just the due diligence aspect, but managing the process of your syndication, your fund, however you want to name it? Who are these people, and because I know it's not just managed by you and your partner, but you guys have a team of individuals. Who are these folks?
So I mean, there's five of us together that are purchasing this property down in just outside of Houston, and so all of us together are working on financial due diligence, verifying income, and all this kind of stuff. As far as like the physical inspections, we hired a third party property management company recommended by one of the partners who's worked with them before,
Okay.
and so that's the team. They went in with a team of 3 to 5 people
Okay.
going and doing the actual physical inspections. You involve third parties like a roofing company to do roofing inspections, an electrician to look at those breaker boxes, and so you involve a lot of people. So whenever you're doing an acquisition like this, there are some upfront costs. You're hiring third parties to do inspections, and the property management company gets, we're basically paying them to manage the property for us.
Yep.
But before that's finalized at the closing of the property, we pay them to do those inspections for us, and
Yep.
things like that. And so there's a, and I wouldn't dream of buying a property like this without all of that.
Yep.
Because one of those things being off or not catching something right off the bat is what can really cause issues later.
Absolutely. Absolutely. Your property managers are going to be like your ears, eyes, and you're essentially your caretaker, because you guys, as the investors and the managers of the fund, are likely not there day to day. So those individuals are very, very key. And then I will also, shameless plug, say that your CPA, your accounting team, if you don't have that individual in house, those people are also really important because they're going to be able to work hand in hand with the property management company to receive information that they need to produce the financial reports. So on that topic, when it comes to the relationship with the investors and what they're receiving and what they're getting, what does that look like if you do have a limited or minority investor come in to participate in the fund?
Absolutely. I mean, in it all it's very much a relationship business. The property management company, we meet with them face to face or at least over Zoom, and really kind of build a rapport. And like they're your team. They're the people that are going to be managing the
Yeah.
day-to-day leasing and all the stuff you don't want to have to do.
Yep. Yep.
They hire or work with the maintenance people, and
Yep.
a lot of it just depends on the size of the
Yep.
property and what you guys want to do with it. But and it's the same with your CPA, with everybody, because as an investor, you want accurate financial reporting from the property, from the fund managers. And so for the investors that I personally bring in, most of which have been accredited. The very first property that I was involved in the syndication for, it was a C offering, so everybody had to be
Yep.
accredited, and reaching out to family and friends and things like that. Um, and when you're when so if you're a passive investor, if you're a limited partner, you don't really necessarily have like decision making powers in the company that runs the property and everything like
Yeah.
that, but your money is involved. You at very least want to be able to have your questions answered. We work very
Yep.
closely with our CPA, with with the property management company, and just build really good relationships with them, because when the partners that you bring in and the team members that you bring in and build, like they're your coworkers for
Yep.
the entire hold of the property, whether that's 3 years or 10 years. And so having a really good relationship with everybody involved is huge. But like your CPA that works with your property management company is going to work and build those financial reports, and especially the cost segregation studies
Yep.
and the depreciation expenses that make a huge impact on the passive investor. I would never do this without a really good CPA. So and I mean, he called it a shameless plug, but I'll plug him too. Jamel is awesome, and I would highly recommend him for anybody that is an investor, passive or active. I recommend Jamel 100%.
I appreciate that, sir. This is all about you today, though. So you mentioned something about cost segregation study, and I think I saw somebody with a comment in there. So I alluded to this earlier. When you are purchasing an investment property, you're purchasing it because you're going to have consistent cash flow with the expectation that you will have consistent cash flow. And that cash flow is going to put money in your bank, in your pocket on a consistent basis. More importantly, you're also going to take advantage of the depreciation expense. And the depreciation expense is going to work a couple ways. It's going to either get depreciated over a 27.5 year period straight line, or 39-year period if it's a commercial type of property. And if we look at 27.5 years or 39 years, that's a heck of a long time for us to really reap the benefits, one of the major benefits of us getting involved with real estate investing. So what happens is, in order to really expedite that process and takes a lot of that advantage in the earlier stages of the life of the investment, what happens is you identify opportunities and strategies in which you can front load the depreciation so that it doesn't have to take a 27.5 or a 39-year period. Instead, we can do it over a much shorter period of time, 5 years, up to 15 years. And now when we identify those particular buckets, we can now start to manage and determine what we want to take, when we want to take, and does it make sense for us to take it. And when you're in a position where you can identify massive paper losses like that, then you're in a situation where you can really, really play the game, the tax game, in terms of using real estate as your weapon. And I tell a lot of my clients oftentimes, if you're a business owner or if you're a real estate investor, high income earner, there is no reason why you should not be using those opportunities to lessen your load. And you have the ability to do so. You just have to know what the opportunities are, how the strategies work, and make sure that your professional that you're working with is having the conversation and communicating with you, rather than just hope and pray that you're doing the right thing. So you actually have to be very proactive with regards to that treatment. So a couple more questions before we actually wrap up, and I'm gonna get to the comment section. When it comes to some advice you would share with some folks that are interested in potentially looking at or taking a look at, what are some encouraging words of advice you would like to share?
The biggest advice I would share, and what's helped me most along the way, is just networking. Even as simple as joining some Facebook groups or going to some events where they're talking about real estate syndications and things like that. Because the people that I've met at those events, and even just on Facebook group, I met a long-term business partner just as part of a Facebook group, and he's been what kind of kickstarted me and got me involved in a lot of the deals that I've been able to take down. And so, you know, networking and really building real relationships with people that are already doing this is my number one piece of advice.
Okay.
You know, you want to do business with people that you like, and other people feel the same way. So you got to be the kind of person that people want to do business with, right?
Yep.
But you know, like
Yep.
I work very closely with my investors. I'm making sure that they're getting their financial reports. I'm making sure that cash distributions are going the right way. I'm always available for questions. You know, some guys that invested in a deal even last year, you know, they still just kind of like, oh, hey, what about this? And so I treat my investors like family, and I'm going to take care of their money as much or more than I would take care of my own. And so, um,
Awesome.
uh, but yeah, that's kind of my biggest piece of advice is to network and really find people that you trust and know could you know, take something like this and make something of it.
Awesome. 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 Um, I saw a question come in from Kevin. His question was, what is the biggest advantage of private equity versus a REIT? So there's two types of ways you can become an investor or purchase real estate. You're either going to do it through your own personal cash, your own capital, or you're going to go through the debt option or equity option. And if we're looking at your own personal cash, pretty much however much cash you have, cash flow you have, that can provide opportunities for you, which is why syndications are huge, because most individuals are not able to go out and buy a 200 unit apartment complex on their own dime. They can do it easier if they bring their money together with others. So that's one option. When we look at debt, that's your traditional way of potentially going to the bank, getting a loan. However, when you go that route, you're in a situation where you have to qualify, stand on your own, show your documentation that you can actually pay the note if you're not paying straight cash for it. So that's one option. And then the other option is your equity option. And the equity is kind of similar to what we're talking about now with the syndications, where we bring our capital together. We either buy in equity or we come in as an investor with our capital. So those are the advantages. When you go the debt route, anybody can do it, but you have to be able to qualify for it depending on who you're working with and who you're going through. Versus if it's an equity type of situation, it's pretty much you bringing cash to the table so you can get into the game and play. And ultimately, you're not just going to play with anyone, but you're going to play with those that you know, like, trust, have familiarity with, and have done some established relationships with. So those are the differences. Hopefully that answered the question. I saw another one that came in. So it's talking about, and this may be a little bit over my head actually. It was talking about finding opportunities out of the country. So I would say going out of the country is a whole nother ball game. Even though it is real estate, you're competing with that country's rules, laws, regulations. But I will say, as an American, if you're going out to invest internationally, you are still liable for your income sources, even if it is earned outside of the country. So just keep in mind. But with regards to the technicalities and the specifics of like what we're talking about, I'm sure there's still a similar process in a different country, but you just need to be familiar with those rules of that land. And I will say that the income certainly is going to be required to be accounted for ultimately in terms of the taxation piece.
Yeah, 100%. I haven't had any experience with investing or putting investor money out in internationally. I have known some that have pooled funds from other company or other countries to invest in something here, and I think that process is a lot simpler.
Yeah,
But me personally, I don't have any experience with anything outside the U.S. Multiple
awesome,
states, but not outside the U.S.
awesome, awesome. All right, one more parting question for you, Joseph, and I want to thank you again for taking your time to share your experience and time with us.
Yeah.
Where do you see the real estate market going now and in the near future? Because the markets are obviously very chaotic one day to the next. rates are unimaginably high compared to what they were a couple years ago. And that definitely impacts individuals' decisions to get involved with the real estate game. But I think it's really important to understand and know that real estate is a huge asset if you're able to get in the mix. And because of something like a syndication, it certainly will make it more feasible versus if you were to go on your own. So I'm just curious from your perspective, where do you see the market going, and is this industry going to still be what it is in the short term as well as the long term, for what we know it to be?
Yeah, absolutely. And I think like overall the economy and the overall market, who knows at this point. But the thing that really got me into real estate and specifically multifamily even then, because people always need a place to live.
Yeah,
And right now the emerging market, the emerging market right now is renters.
yeah,
Like it's with and that's another reason multifamily is so great, is because right now people are struggling to buy because of interest rates. They can't come up
yeah,
with a down payment, or they can't quite, they make enough money to make a mortgage payment, but they don't qualify, or can't quite get the loan or the mortgage
yeah,
loan.
yeah,
And so they rent. And there, I could go on and on about renters demographics and stuff. I've done a lot of research on stuff like that. But um real estate has been the best performing asset over hundreds of years. I mean, dating all the way back. I mean, when our country was founded, the people who wrote the laws were the landowners. And to this day, the people who write legislation, they own real estate.
yeah,
And so, and that's why one of the biggest reasons why a lot of the tax benefits favor real estate investors, people who own real estate. And multifamily, for me, looking at historicals and looking at projections for the future, multifamily real estate, the big, large commercial size multifamily real estate, these big complexes have been the most stable, high performing asset for the longest time. I've had friends that lost money in crypto. I had friends that invested in tech companies that lost a bunch of money when the bank crisis happened, and all that kind of stuff. Eh, Look at the Great Depression. The people who came out on top were the people who owned stable assets like real estate.
yeah,
And so in the future, regardless of what's going to happen, finances and interest rates and where all of this is going, the one thing I do know is that real estate like this is going to be the most stable going forward, because historically it always has been, and I don't see any indication that that's going to change.
yeah, yeah,
That's my take anyway, and that's why, like, the money that I do have to invest is all going into this.
yeah,
um
yeah,
there's so many ways to lose money, and I've never known anybody that lost money investing in
mhm,
deals like this.
yeah,
They've always made money. Sometimes it's less or more than what they wanted or expected, but almost always more, and always in the positive, with investments like these. These kind of cash flowing assets. It's all about the operators though, because you got to buy the right property at the right
yeah,
price, the right
yeah,
location. There's a lot of
yeah,
different factors, but you find the people that can get the good deals, then it'll make a big difference. I've got a whole ebook on that I came
yeah.
out with about the kind of partners you look for, and how to find the right properties and who to work with, and all that kind of stuff. So
Awesome, awesome, awesome. You mentioned that, and I want to thank you, Joseph, for spending some time with us today. This is a huge treat, and I appreciate you for sharing your experience, your wisdom. And he mentioned he has an ebook. So for those of you that are on the call, we'll for sure be reaching back out to you so you can access that for free. Some very valuable information in there for you guys, to really highlight some of the stuff we discussed and get into some more detail. And then Joseph, how can folks get in touch with you if they ever need to reach out or learn more about you?
I just put it in the chat. My website is jpaulcap.com. And if you do /ebook, it should take you right to the ebook page. But if you go to jpaulcap.com, there's right on the top bar, it says new ebook. you can click on
Awesome.
that and to access the ebook. You can download it. You can view it online, however you want to do it. But it's a good resource. There's a lot of information on my company and what we usually offer to investors and things like that. But I'm grateful for the opportunity to be here and to share some knowledge. That's how I got started, was because people were willing to share their knowledge.
Yeah.
So thank you
Yeah.
for the opportunity.
Awesome. Well, thank you, sir. Appreciate it. I thank you guys for hopping in on the call, and hope this was a good one for you. I will be catching up with you all on the next conversation, so be on the lookout, and hope you guys have a great rest of your day, Friday, weekend, and take care.
Thanks, guys.